If you put $1 million in a safe and leave it there for 10 years, you will still have $1 million. But you will not have the same purchasing power. No one stole it. No one hacked your account. No crisis touched your house. Yet you became poorer. That uncomfortable truth is where we begin. Most people think prices go up because companies are greedy or because things are getting more expensive. But that explanation is shallow. Prices rising is only the surface. The deeper reality is that the value of money itself changes. To understand this, imagine a small town with 100 people. In this town, there are exactly 100 loaves of bread, and there is exactly $100,000 in total circulating among everyone. On average, each loaf costs $1,000. Everything is balanced. The amount of money matches the amount of goods. Now imagine the town council decides to stimulate the economy. They inject another $100,000 into the system. No new bread is baked. Production stays the same. Now the town has 100 loaves of bread, $200,000 in total money. What happens next? Bread doesn't magically double, but money does. So the price adjusts. Instead of $1,000 per loaf, it trends toward $2,000. Bread didn't become better. The baker didn't suddenly turn evil. The money simply became less scarce. That is the core mechanism. Inflation is not primarily about prices rising. It is about the purchasing power of money declining. And here's the part most people never ask. Why would a system allow that to happen? Because a small amount of inflation is considered useful. Imagine the opposite world. Imagine money always gains value over time. If you knew that holding cash would allow you to buy more next year, what would you do? You would wait. You would delay purchases. You would avoid investing. If everyone waits, businesses cannot sell products. They reduce production. They lay off workers. Income falls. Spending falls further. The economy slows down in a spiral. So modern economic systems aim for mild, steady inflation, around 2% per year in many developed countries. Not enough to panic people, just enough to keep money moving. Now let's go deeper into how new money actually enters the system. Governments spend money on infrastructure, healthcare, defense, salaries, and social programs. Sometimes tax revenue covers these expenses. Often it does not. When spending exceeds tax income, there is a gap. That gap must be financed. Step 1. The government issues bonds. Investors, banks, and institutions buy those bonds, effectively lending money to the government. Step 2. If demand for those bonds weakens or the government wants lower borrowing costs, the central bank can step in. The central bank buys government bonds using newly created money. This money does not come from a printing press in the traditional sense. It is created digitally within the banking system. Step 3. Banks now hold more reserves. With more liquidity, they are able to lend more. Loans for homes, businesses, and investments become more available. Step 4. The newly created money begins flowing into the economy, but it does not spread evenly. It usually enters through financial markets first. Asset prices respond quickly. Stocks rise. Real estate prices increase. Bond markets adjust. By the time the new money reaches wages and consumer goods, asset owners have already benefited from rising valuations. This uneven flow has a name in economic theory, but the principle is simple. The first recipients of new money gain. Most people think debt is bad. You are told from childhood, don't owe anyone. Debt is dangerous. Live within your means. At a personal level, that advice makes sense. But here's the contradiction. Modern economies are built on debt, not just a little debt. Massive debt. Governments run deficits. Corporations issue bonds. Banks create loans. Consumers borrow for homes, cars, education. If debt is so dangerous, why is the entire system structured around it? To answer that, we need to understand one uncomfortable reality. In modern banking systems, most money is created through lending. Let's simplify. Imagine a bank with $1 million in deposits. Traditionally, you might think the bank can only lend that $1 million. But modern banking doesn't work that way. When you apply for a loan, the bank does not go into a vault and hand you someone else's cash. Instead, when the loan is approved, the bank creates a deposit in your account. That deposit is new money. It did not exist before the loan. On the bank's balance sheet, your loan becomes an asset for the bank. Your deposit becomes a liability for the bank. Money is created the moment debt is created. Now zoom out. If banks collectively issue more loans, the money supply expands. If loans are repaid faster than new loans are issued, the money supply contracts. Debt is not just borrowing. It is a primary engine of money creation. This changes everything, because now economic growth is tightly connected to credit growth. When businesses borrow to expand factories, hire workers, and produce more goods, debt fuels productive growth. When families borrow to buy homes, construction increases, employment rises, and related industries expand. In this sense, debt can be productive, but here's the catch. Debt must be repaid with interest. That means tomorrow's income must be larger than today's debt. For the system to remain stable, income, productivity, and economic output must keep expanding. Growth is not optional. It becomes necessary. Now consider what happens when debt grows faster than real productivity. Let's return to a simplified town. Suppose businesses borrow heavily to speculate on land instead of building factories. Property prices rise. People feel richer. More borrowing follows. Prices rise further. Nothing new is being produced. No extra goods. No new technology. Just higher prices. This is not productive debt. It is speculative debt. When confidence fades or incomes fail to support repayments, the cycle reverses. Banks tighten lending. Asset prices fall. Borrowers struggle. Defaults rise. And because loans created money in the first place, when loans are destroyed to default or repayment without replacement, money disappears from the system. Credit contraction leads to economic slowdown. This is why recessions often follow credit booms. Debt expands. Optimism grows. Risk increases. Then reality intervenes. Now let's separate two ideas that are often confused: personal debt and national debt. Personal debt is straightforward. If you cannot pay your mortgage, the bank can take your house. If you default on credit cards, your credit score collapses. There are hard constraints. National debt is different. A government that controls its own currency can issue bonds denominated in that currency. It can roll over debt. It can refinance. In extreme cases, it can rely on central bank support. That does not mean government debt does not matter. It means the mechanics are different. A household must earn before it spends. A sovereign government can spend and then finance. However, there are limits. If markets lose confidence in a government's ability to manage its finances responsibly, borrowing costs rise. If the central bank finances deficits excessively, inflationary pressure can build. The key difference is flexibility, not immunity. Now consider another contrast: debt for consumption versus debt for investment. If you borrow $10,000 for a vacation, the experience may be meaningful, but financially, the money is gone. You still owe principal plus interest. If you borrow $10,000 to start a business that generates $30,000 in profit, debt becomes a lever. Good. Now, let's tackle another question almost everyone is asked at some point. Why do stock markets go up over the long term, even when the economy feels unstable? It often feels disconnected from reality. You hear about layoffs. You see rising prices. You feel financial pressure. And yet the stock market hits new highs. Is it manipulated? Is it fake? Or is something deeper happening? Let's strip it down. Imagine again our small town of 100 people. In this town, instead of just bread, there are businesses. One bakery, one construction company, one transport service, one farm. Each business produces real goods and services. They generate profit. Now imagine the bakery makes $100,000 per year in profit. If you own 100% of the bakery, that $100,000 belongs to you. But instead of owning the entire bakery, ownership is divided into 1,000 shares. Each share represents 0.1% ownership. If the bakery earns $100,000, each share represents a claim on $100 of profit. That is what a stock fundamentally is. Not a ticker symbol, not a flashing number. It is ownership. Now let's move to the real world. When you buy a stock, you are buying a piece of company. If that company grows revenue, increases profit, expands globally, and becomes more productive, your ownership stake becomes more valuable. Over long periods, businesses innovate, technology improves, productivity increases, new products are created, old inefficiencies are removed, markets expand internationally. This is economic growth, and stocks represent ownership in that growth. Now, here's the key distinction many people miss. The stock market is not the economy. It is a market of publicly traded companies. If small businesses struggle but large multinational corporations grow globally, the stock market can rise even while parts of the economy suffer. That's the first disconnect. Now, let's go deeper into how stock prices are actually determined. Stage 1. Expectations. Stock prices are not based on what a company earned last year. They are based on what investors believe it will earn in the future. If investors expect strong future profits, they are willing to pay more today. If expectations fall, prices drop. Even the company is still profitable. Stage 2. Interest rates. Remember earlier when we discussed debt and money creation? Interest rates influence stock valuations. If interest rates are low, borrowing is cheaper. Companies can invest more easily. Investors searching for returns move money from savings accounts and bonds into stocks. Low rates often push asset prices higher. Now let's address one of the most emotionally loaded financial questions. Why does it feel like you are working harder but not getting ahead? Your parents bought a house on one income. You need two. They saved modestly and retired. You save and still feel behind. Is it personal failure or structural change? Let's break it down from zero. Imagine again our small town. There are 100 people. Each produces something. Total annual production in the town equals $10 million. If total production rises to $12 million next year, the town is richer. More goods, more services, more value created. That increase is economic growth. Now here's the key distinction. Economic growth does not automatically mean individual prosperity. Growth can be unevenly distributed. If most of the additional $2 million goes to business owners and asset holders, wage earners may see little change. Now let's examine wages. Your wage is the price of your labor. Like any price, it depends on supply and demand. If your skill is rare and highly productive, demand is high, wages rise. If your skill is common and easily replaceable, wages stagnate. Over the last few decades, technology and globalization dramatically increased the supply of labor competing for similar roles. A company can outsource work internationally. Software can automate repetitive tasks. Artificial intelligence can enhance productivity per worker. When productivity rises, but bargaining power does not rise equally, profits can grow faster than wages. Now combine that with inflation. If wages increase 3% per year, but living costs increase 4%, your real purchasing power declines. You feel stuck, even if your salary number is larger. This is the illusion of nominal growth versus real growth. Nominal income is the number printed on your paycheck. Real income is what that paycheck can actually buy. The difference matters. Now let's look at housing, one of the biggest pressures. Housing is not just a consumption good. It is also an asset. When interest rates fall and credit becomes easily available, more buyers can borrow larger amounts. If supply does not expand fast enough, prices rise. Homeowners benefit from rising property values. New buyers face higher entry costs. Over time, asset appreciation can outpace wage growth. This creates a divide between those who already own assets and those trying to acquire them. It feels unfair because structurally, it is asymmetric. Asset prices respond quickly to liquidity and credit conditions. Wages adjust more slowly. Now let's introduce another concept, compounding advantage. If someone owns assets early, those assets appreciate. That appreciation can be reinvested into more assets. Those assets generate more returns. Meanwhile, someone without assets relies solely on labor income, which grows linearly, not exponentially. Labor income grows step by step. Asset returns can grow on top of previous returns. Over long periods, that gap becomes wide. Now consider taxation. In many systems, labor income is taxed at higher rates than capital gains. Wages are taxed immediately. Asset appreciation may be taxed later, sometimes at lower rates. Again, the system structurally favors ownership over pure labor. This does not mean the system is evil. It means incentives shape outcomes. Modern economies incentivize investment, risk-taking, capital formation. They reward those who allocate capital efficiently. Now let's examine productivity. Productivity is output per worker. If productivity rises 5% but wages rise only 2%, the remaining gains go elsewhere, typically to profits. Over time, the share of national income going to capital versus labor can shift. This shift changes how growth feels at the individual level. Even in growing economies, median households may feel pressure if asset inflation outpaces wage growth. Now, let's contrast two mindsets. The consumption mindset focuses on earning and spending. The ownership mindset focuses on earning and acquiring assets that generate returns. In a stable, low-growth world, both might produce similar outcomes. In a credit-driven, inflationary system, they diverge significantly because inflation slowly erodes idle cash and asset appreciation compounds over time. This is why many financially advanced individuals prioritize equity ownership, business participation, real estate, diversified investment portfolios. They aim to align themselves with structural growth rather than only exchanging time for money. Now let's be realistic. Not everyone can start a company. Not everyone can buy multiple properties. But participation does not require extreme wealth. Broad-based index funds, retirement accounts, and disciplined long-term investing allow ordinary individuals to own small pieces of productive enterprises. The key shift is conceptual. Stop seeing yourself only as a worker inside the economy. Start seeing yourself as a partial owner of it, because the system is designed to grow through capital accumulation and credit expansion. If you remain purely a wage participant, you are exposed to inflation risk, automation risk, wage stagnation risk. If you become a capital participant, you are exposed to market volatility, business cycles, asset risk. Both carry risk, but they are different types of risk. The deeper question is not which is safe. The deeper question is which risk aligns with how the system actually operates. Now step back. Inflation slowly reduces purchasing power. Debt expands money supply. Stock markets represent ownership of productive assets. Asset prices often rise faster than wages. When you connect these pieces, the feeling of working harder but not advancing begins to make structural sense. It is not just about effort. It is about position. Are you positioned only as labor or also as capital? And here is the final reflection for this section. If the rules of the game reward ownership, compounding, and productive risk-taking, what small structural shift could you make today to move from being only a participant in the economy to being a partial owner of it? Now let's step into one of the most misunderstood forces in modern finance. Why do interest rates control almost everything? People think interest rates only affect loans, mortgage rates, credit cards, car financing. But in reality, interest rates are the gravitational force of the entire financial universe. They influence asset prices, stock markets, housing affordability, business expansion, government debt, currency strength, even employment levels. To understand why, we must begin with a simple idea. Interest rates are the price of money. Just like rent is the price of housing, interest is the price you pay to use someone else's capital. Imagine two versions of yourself. Version 1 can spend $10,000 today. Version 2 must wait 1 year to receive $10,000. Which version is more valuable? Most people prefer money today because money today can be invested, spent, or used to solve immediate problems. This concept is called the time value of money. Interest rates exist to compensate lenders for giving up present money in exchange for future repayment. Now let's zoom out. In modern economies, central banks influence baseline interest rates. They do not control every loan rate directly, but they set the foundation that influences borrowing costs across the system. When central banks lower interest rates, borrowing becomes cheaper. When they raise rates, borrowing becomes more expensive. That sounds simple, but the ripple effects are massive. Let's walk through it step by step. Stage 1. Lower interest rates encourage borrowing. If mortgage rates drop from 7% to 4%, monthly payments fall significantly. More people can afford to buy homes. Demand increases. Housing prices often rise. Businesses also benefit. Lower borrowing costs make expansion projects more attractive. Companies invest in equipment, hire employees, and open new locations. Consumers feel wealthier when asset prices rise. They spend more. Economic activity accelerates. Stage 2. Lower interest rates influence investment behavior. When savings account and government bonds pay very little interest, investors search for higher returns elsewhere. Money flows into stocks, real estate, private businesses, venture capital. Asset prices rise partly because money needs somewhere to go. Stage 3. Higher interest rates reverse the flow. When rates increase, borrowing becomes expensive. Mortgage payments rise. Housing demand slows. Property prices may stabilize or decline. Businesses reconsider expansion plans because financing costs increase. Investors shift money into safer assets like bonds, which now offer higher returns. Economic activity cools down. This is why central banks often raise rates to slow inflation and lower rates to stimulate growth. Now, let's examine a deeper effect that many people never notice. Interest rates determine how future profits are valued today. Imagine a company expected to earn $1 million 10 years from now. How much is that future profit worth today? The answer depends heavily on interest rates. If interest rates are low, future money is discounted less. Investors are willing to pay more today for future profits. Stock valuations rise. If interest rates are high, future money is discounted more aggressively. Investors pay less today for the same future profit. Stock valuations fall. This is why technology companies, which often rely on long-term future growth, are especially sensitive to interest rate changes. Now, let's connect interest rates to government debt. Governments borrow by issuing bonds. When interest rates rise, new government borrowing becomes more expensive. Debt servicing costs increase. Budget pressure builds. If large portions of tax revenue must be used to pay interest, governments have less flexibility for infrastructure, social programs, or economic stimulus. This creates difficult policy choices. Now consider currencies. Higher interest rates in one country often attract foreign capital seeking better returns. Increased demand for that country's currency can strengthen its exchange rate. Lower interest rates can weaken currency value because investors move money elsewhere. Currency strength influences import prices, export competitiveness, and inflation dynamics. Now let's talk about risk. Interest rates represent the baseline risk-free return in many financial models. If government bonds yield 5% with minimal risk, investors demand higher returns from riskier assets like stocks or startups. If bonds yield 1%, investors are more willing to accept lower expected returns from risky assets. Interest rates shape how risk is priced across the entire financial system. Now let's examine how this affects ordinary individuals. Low interest rate environments tend to reward borrowers and asset owners. Loans are cheaper. Asset prices often rise. High interest rate environments reward savers and fixed income investors. Savings accounts and bonds provide meaningful returns. Borrowing becomes harder. Each environment benefits different groups. This creates financial cycles. During low-rate periods, debt levels often expand. Asset prices climb. Optimism grows. During high-rate periods, borrowing slows. Asset markets correct. Economic growth cools. Neither environment lasts forever. Economies oscillate between expansion and restraint. Now consider psychological impact. Low interest rates can encourage risk-taking. Investors may underestimate danger because borrowing feels easy and asset prices keep rising. High interest rates can encourage fear and conservatism. Investors may avoid opportunities because financing feels restrictive. Both extremes can distort rational decision-making. Understanding interest rates helps you step outside emotional cycles and recognize structural shifts. Now let's examine a subtle but powerful insight. Interest rates influence inequality. When rates fall, asset prices often rise faster than wages. Asset owners benefit disproportionately. When rates rise sharply, Heavily indebted households and businesses face pressure, but savers and conservative investors benefit. Interest rate policy often redistributes wealth indirectly, even though that is not always its primary intention. Now step back and look at the system as a whole. Interest rates regulate how fast credit expands, how expensive debt becomes, how assets are valued, how capital flows globally, how governments finance spending, how businesses plan growth. They are not just numbers announced by policymakers. They are signals that ripple through every layer of economic life. Understanding interest rates changes how you interpret financial news. Instead of reacting emotionally to market swings, you begin asking structural questions. Is money becoming cheaper or more expensive? Is liquidity expanding or contracting? Which sectors benefit from this shift? Which assets become vulnerable? Those questions reveal the hidden mechanics behind market movements. And now, here is a deeper reflection. If interest rates determine the cost of money, the value of future income, and the direction of capital flows, are your financial decisions based on personal circumstances alone, or on understanding where money itself is becoming cheaper or more expensive within the system? Let's bring everything together. We've talked about inflation. We've talked about debt. We've talked about stocks. We've talked about interest rates. Now, let's answer the deeper question underneath all of them. How does the entire financial system actually fit together? And where do you stand inside it? Most people see money as something they earn, spend, and save. But zoom out. The modern financial system has three core engines: credit expansion, managed inflation, asset ownership. These engines interact constantly. When credit expands, new money enters the system. When money expands faster than goods and services, inflation rises. When inflation rises, asset prices often adjust upward. When asset prices rise, owners of those assets gain wealth, and the cycle continues. Now, let's visualize it step by step. Step 1. Banks create credit through lending. New loans increase money supply. Businesses expand. Consumers spend. Economic activity grows. Step 2. Central banks adjust interest rates to manage inflation and growth. If the economy overheats, rates rise. If the economy slows, rates fall. Step 3. Asset markets respond first. Stocks and real estate react to changes in liquidity and interest rates quickly. Step 4. Wages and consumer prices adjust more slowly. This lag creates asymmetry. Those closest to capital markets react early. Those dependent solely on wages adjust late. This is not conspiracy. It is structure. Now, let's talk about the illusion of security. Many people believe safety means avoiding risk entirely. They hold cash. They avoid investing. They avoid leverage. It feels safe. But in a system built on gradual currency erosion and asset appreciation, avoiding all risk carries its own hidden risk. Erosion of purchasing power, missing out on compounding, falling behind asset inflation. On the other extreme, excessive risk-taking can destroy wealth quickly. Speculation, over-leverage, chasing trends. The goal is not to eliminate risk. The goal is to choose which risks align with structural realities. Now, let's contrast two financial identities. Identity 1, the pure consumer. Earn income, spend income, save leftovers in cash. This identity depends entirely on wage growth, keeping pace with inflation. Identity 2, the capital participant. Earn income, convert portion into productive assets, reinvest returns. This identity participates in the same forces that drive systemic growth. Over long time horizons, these identities produce very different outcomes because of compounding. Compounding is not dramatic in the first year, or the second, or the fifth, but over 20 or 30 years, small consistent returns multiply dramatically. If you invest $10,000 annually at 8% return, after 30 years the result is not $300,000. It is far more due to accumulated growth on previous growth. This is how asset ownership quietly builds wealth. Now let's add one more layer: psychological discipline. Understanding the system is intellectual. Acting correctly within it is emotional. During booms, fear of missing out pushes people into overpriced assets. During crashes, Fear pushes them out at the worst time. Financial maturity requires understanding cycles. Booms create overconfidence. Busts create despair. Neither lasts forever. Now consider generational impact. Those who understand the system early can align their behavior with long-term structural growth. Those who misunderstand it may chase short-term signals and remain reactive. Education alone does not guarantee wealth, but ignorance of structural forces almost guarantees vulnerability. Now here's the uncomfortable truth. The financial system is not designed primarily for fairness. It is designed for efficiency and growth. It rewards capital allocation, productivity, ownership, long-term patience. It penalizes idle capital, emotional decision-making, short-term speculation disguised as investing. Once you see this, financial news becomes less dramatic. Market crashes become cyclical events rather than existential threats. Inflation becomes a variable to manage rather than a mysterious enemy. Interest rate changes become signals rather than surprises. And debt becomes a tool, not moral failure or blind opportunity. So where does this leave you? You cannot control global monetary policy, interest rate decisions, geopolitical shocks, technological disruption, but you can control your savings rate, your investment discipline, your risk management, your time horizon. The system will continue evolving. Inflation will fluctuate. Credit cycles will expand and contract. Markets will rise and fall. The question is not whether volatility will exist. The question is whether you understand the rules well enough to remain rational while others react emotionally. Let's end with one final reflection. If money slowly loses value, if credit expansion fuels growth, if asset ownership captures productivity gains, if interest rates steer capital flows, then financial success may not be about predicting the future. It may be about positioning yourself correctly within a system that already has predictable structural tendencies. So here's the last question. Are you building your financial life based on headlines and emotions, or on understanding how the system actually works underneath the noise?